Welcome to the Private Lenders Podcast with your hosts from Hard Money Bankers, Jason Balin and Chris Haddon. This podcast is sponsored by HardMoneyMastermind.com.
Welcome back to the Private Lender Podcast. My name is Jason Balin from Hard Money Bankers, and my guest today, Ian Horowitz from Equity Warehouse. Ian's been a great friend of mine and Chris's for going on 10 plus years now, and we're partners in several commercial real estate projects. He's also the co-host of another podcast that I run called the Real Estate Reserve Podcast that's geared to our borrower clients and real estate investors. So I wanted to bring Ian on the podcast today since he's a very experienced real estate investor that has been involved in hundreds of deals to kind of, debunk the myth that so many hard money lenders have that they just can't compete with institutional backed lenders, or so they think. And really, it's a limited belief that all good real estate investors in general, they don't only care about the cheapest rate or the highest leverage. I know that might seem like that's the case when you're talking to them, but they don't. And more private lenders just have to shift their mindsets and their brains that experienced real estate investors understand the value of easy and private capital over cheaper and pain in the butt funds. And there's lots of different capital out there. And, if you're watching this live, Ian's, obviously agreeing with me, and I'm taking all the attention, even though that he's my guest. So first off, Ian, thanks so much for hopping on Private Lenders Podcast. I can't believe after 250 plus episodes, you've never been on this show, but thanks for joining us, and maybe just tell everybody a little bit about yourself.
Yeah, well, thanks for having me on. My name's Ian with Equity Warehouse. We do co-host another podcast together, which has been really fun to do, the Real Estate Reserve Podcast. As our relationship has deepened from actually my business partner was a early coaching client of someone in your office, to becoming borrowers, to ultimately becoming co-investors in a lot of different deals, to literally talking every day. And I didn't know I was going to be hopping on here, so I'm kind of rambling on. But with that being said, we do co-invest and co-lend with our friends and family into commercial real estate. That's primarily what we do today. But, we had very humble beginnings in investing in single family residential real estate, from flipping to rental properties, and we have grown from there. So exactly what you talked about applies not only from those days, but even in the commercial space. And we can kind of case study each little different thing. Because I'm thinking about SEMS or some of the other deals we've done inside of some of the commercial stuff. And I think it'd be really good for your audience to talk about that.
Yeah. I mean, we've been involved with in a lot of deals together. And even before kind of institutional capital came on the map, or it's kind of like, that's probably when you got into the space. Yeah, you were in the space before institutional capital was certainly around, and you saw it kind of come around, and you spent years and years and years with just flipping or buying and holding single family houses, right? So it's really only been the last 5 years that you've got into self-storage facilities and apartment buildings and commercial stuff, and now happy to give you a shameless plug of your new energy drink called Buffed Energy. Definitely a good, interesting business model. If you've never followed Ian, and actually Ian's been to several of our inner circle events, so there's a lot of folks in our community that have known Ian, and he's provided value to the group by just kind of going through how he structures some of his commercial deals and how he finds them and how he raises capital for them and things like that. But they also had this impressive audience called for Facebook and Instagram and TikTok, Brotherhood Buffs, because he's an ex-fireman, and they created some very viral content out there. And then, being an entrepreneur and a opportunistic person, he created an energy drink that was geared towards, first responders and things like that. If you're into caffeine, I know a lot of folks are. 200 milligrams, it's right up people's alley. Probably kill me if I had a heart attack.
You'd be jumping. But when I come to Charles, I'm gonna come to Charleston. I already put it on the calendar. I don't know if you told your audience, but either way, your next inner circle event. I guess I wasn't supposed to say anything. With that being said, I'm
booked for the most part. Everyone's already
there. You go.
That group's full.
All right. Well, then I'm packing some Buffed. I'm driving down and come visit my brother, and I'm going to come hang out with you guys because I'm excited to see what that looks like. And I just like going to hang out and talking to private lenders, because as much as it's me telling you how I view the capital stack, like it's also interesting to hear how you guys view the capital stack back, right? Because there's a big difference in me talking to a bank than talking to you, than talking to my friends and family, right? And I know there's certain guidelines if I go and borrow bank money, and then there's certain guidelines when I borrow money from you, and then there's different guidelines, even though it's all in the end treated the same. It's just different guidelines as a whole, I guess is the best way to say it. And I think knowing the deal that you have and matching the right capital to the deal is where it fits. I think too many people get caught up in you call it the interest rate game, but I think people get caught up in, do I want that or I don't, right? But you're a asset-backed lender in the end, but like I'm still putting my name out there to borrow money from you. And I don't know where I'm going with this, but like, to me, it's the same if I borrow money from you, if I borrow money from my friends and family, or if I borrow money from the bank. I have way more motivation for my friends and family, and then you, and then the bank, right? Kind of in like a tiered fashion is kind of how I view it, right? And
Yeah.
So.
Yeah. No. No. And I agree, and it makes a lot of sense. And you know, one of the things that I remember from earlier on when we were working, you know, doing some early on deals is, I mean, you were doing a lot of deals, so I wasn't obviously doing all of them, you know,
Right.
and I think that's a learning lessons that most real estate investors that work with a hard money lender, like the lender, you don't have to expect to get every single deal. I mean, I've done loans for borrowers that do 40, 50, 100 deals a year. If I can get 2 of them or 8 of them, like I'm happy as hell. Like that's fine. Like I'm not expecting them. We don't, you know, and I use this in my sales scripting, like we're not the perfect lender for every situation. So there was a deal years ago, like early on with on Ian's end, after we kind of built relationships and he knew that we could close quick, that, you know, he was obviously not necessarily shopping around, because I think big real estate investors, they don't waste time shopping around. Some of the newer ones might, you know, just because they don't know what's out there. But like the experienced ones, they know what's up. And this was also before institutional capital, but it was lenders that were willing to give 100% financing if we were not. And it was a lender that was willing to give cheaper terms. And I remember you were doing a deal with somebody and he was just a pain in the ass to deal with. He was a local lender. He would make you and your partner sign.
Mm-hmm.
I mean, there's a few lenders that meet this description. Some of them made your spouses sign as well, which is just a freaking headache. And like you went down that road first just because it was like he's easier. I don't know what the terms were, but let's just say they were probably 10-2 instead of 13-3. And, you know, the deal might have been slightly tight, so every dollar counts. And, you know, eventually you called me and you were like, dude, I've had enough with this deal. It's a pain in the ass. I just need to get this thing closed. Let's go. And we closed quick. And
well,
go ahead.
I don't know if you remember, but the guy made me leave the beach. I was away on vacation. He said, you and your wife have to leave your vacation and come sign the paperwork or I'm not closing. But like side by side with that, like our reputation's equally as important to the realtors and the wholesalers who are bringing us deals at that point. And I'm like, no, go pound sand. Right. And like, I think that's when we started to realize like a few points difference, because this is what goes through my head, right? It's like, okay, that guy is 10-2, but Jason's just say 13-3. And I'm like, well, on a 6-month time horizon for the $150,000 I need, like, oh, I'll get it done in 6 months. And yeah, maybe it takes me 8 months, whatever. It's so minuscule in the grand scheme of things that it's like, it shouldn't matter. And I think we kind of took that approach, and that's why we got more deals done than most people. And we were able to execute faster. And then side by side with that, like as we had that realization, we also kind of set up a bank guidance line, right? And it was like, well, I could put all my money in this bank guidance line, but then I got to jump through hoops for an appraisal. I got to do all these other things. So in my head, it was like, well, if I borrow money from Jason and Chris or a couple other lenders that we had, because we would bounce around, I would borrow from them. Then I would go use the long-term money when I was ready to refinance that property, and I had time to get it all figured out, right? And there was plenty of times where like Jason wasn't the best fit, right? Like in this instance, Jason was the best fit, but then there was other times where it's like Jason doesn't touch the city. And I would always I would mess with him. I was like, yo, come on, man. Like, you want to do this one in the city? Like, I'll give you $50,000. I'm like, oh, never mind. You know, and I would just do it to mess with him. But you know, you always got to kind of like barometer test and converse and build relationship. But I knew my city guy that I would go to. And then there was also like as a borrower, like, you get into a guy for $1 million, you're kind of like, I think I've kind of hit my limit. And it's like, all right, well, now that I've maxed out it's almost like lines of credit. It's like, all right, that guy's comfortable with 3 deals. Let me go find another guy. This guy's comfortable with me doing 2 deals, and kind of bouncing around. There's similar terms, similar requirements. Some guys are easier to fund, others weren't. But look, in the end, like, you just need to match the capital and getting the deal done, because I'm not going to sit there and wait for an appraisal. The other problem at that time, it was it Lima One? Is that who the big guys were? The big institution?
Lima One was early on institutional capital.
Yeah, it was Lima One and somebody else. There's go to Lima One. They'll give you this, and this. I'm like, dude, you got to jump through every single hoop. It's like not worth it to me. And you're taking 6 months to close the deals. I've already turned 5 deals in that 6-month time frame. It's not worth my time.
And here's the thing, like, this is coming from somebody who's done lots of deals, so you can understand his mindset compared to a lot of other investors that you might be talking to that just don't, like, that's not the industry norm of like, hey, I got to find the highest leverage and I got to find the cheapest terms. Like, newer investors might be like that. And listen, there's lots of scripting that I've talked about of winning those deals, say, hey, we might not be the best fit for you. But again, like, there's different situations that it might work and it mihad not work. And, think about it on the borrower's side as well. Like, put yourself in their shoes. Even if you had a superior product, it still doesn't benefit them to do every deal with you, because there could be a case that you go out of business or you're out of money or something, and then they put all their eggs in one basket. It's the same reason when we take on private investors and private capital, we try not to have one person or one group have more than like 10 or 20% of our entire $50 million pool of capital, because like if they disappear, I'm scrambling, especially as you build a book of business. Go ahead.
I would also say, like, you're doing them favors, right? Like, you're doing the borrower a favor. Say, like, okay, Jason, what's your terms? 65%, right? Or something like that, and 13 and 3. And it's like, okay, well, you're at 65% and 13 and 3. And let's just say I could do 3 deals with you. And then I used to use this guy, Mr. Brian. I could do like 5 deals with him. And there was a couple other guys in the marketplace. You know what I was doing, though? I was building a balance sheet that allowed me to get to the bank to exit. I was building a book of business that then allowed me to say, hey, friends and family, you want to do 1 deal? And then I'm starting to build rapport. So, like, it's a 2-way street, because then what I was doing was, like, everyone's like, who do you call? I'm like, well, Jason and Chris helped me out on all these deals. Refer them there. Or if it was a city deal, it would go to Mr. Brian, right? Like, and just then you start passing it around. It like really becomes a give-take relationship that allows each side of this transaction to level up. I know that's not what you're like, what we kind of talked about originally on this podcast, but I'm sitting here thinking about it and talking about it. It's like, it was important for me to have multiple lenders and know who to utilize and have a book of business and continuing to be able to grow that, because it helped me leverage to my next level the same way it allowed you to say, well, look, I got Ian on the books. I know you wouldn't do it that way, but hey, I got Ian on the books. I got this borrower. He's got 3 loans with me. He performs on all of them. Here's his track record. Now you could go raise more money. And I think that's what's beneficial. And it's not so much about the leverage piece or the interest rate as much it is I could pick up the phone, call Jason. I kind of already knew where he was going to be, because I got this mental picture. I'm like, all right, Jason's going to be at 65%. I know his terms. I know what I got to do. He's going to make me jump through some hoops. Fine, whatever. It's done. I just want to get this deal done and keep it moving,
Yeah. So I remember having a conversation with you maybe a few years ago as well, because you understand this. And that's the whole purpose of this episode is, try to get in your head of, what an experienced real estate investor that a lot of hard money lenders are chasing to try to get their deals. That I was talking to somebody in our group, and they were like, man, I just can't compete with Kiavi. Like, I can't compete with Kiavi. And I was, talking to you about it. And you're like, what do you mean? Like, that doesn't make any sense. And I agree. Like, it didn't make any sense. And this lender just wanted to try to compete with Kiavi. And they thought like that was their competition. And it was a completely different product. It's apples to oranges. Like, Kiavi, super cheap terms, high leverage, poor customer service, takes a long time. They probably outsource. I don't know if they probably outsource servicing, but like construction draws take a long time. The process is very, very clunky. Lots of documentation, things like that. So really the only thing they bring to the table is cheap terms and higher leverage. And those are important things, no doubt. I don't disagree with that. But like, this person was having a hard time selling against them. of like, well, why would it was almost like the belief of like, why would anybody ever use my product? Because there's a cheaper product out there. And like they're trying to commoditize private lending. And like you can't. It's not that. Like this isn't equal products. This isn't like going to the store and being like, hey, there's 2 boxes of cereal, the exact same thing. One's $3.50, $1 is $4. Which one do I buy? You buy the $3.50 because it's the exact same thing. And that's not the case. And I remember talking to you about this, and you were like, you were upset about it on the borrower side, be like, that's the most outrageous thing ever. Like, do they know like what these institutional backed lenders like they're
well,
not.
I think it's the allure. And I mean, we know the institutional ones right in our backyard, right? And I laugh every time because everyone's like, I'm going to do what are they? Not no doc. What do they call them? Basically no doc loans, right? Like where you have no security to it. And I'm like, who cares, dude? Like, I know I can call Jason and Chris and get the deal done. Or I got this group of lenders that I can call and get the deal done. And high leverage is cool, but like I need to know that I can close because my rapport back to the wholesalers is the most important thing. My rapport back to the realtors and the title companies and everybody else is the most important thing. I can't have it take several months. I mean, it's just silliness. And then the appraisal reports that you get are all trash, and everything else. And I guess the other thing, what I would say is like, I don't think enough lenders really realize the service that you're providing to borrowers, right? And as like a legitimate real estate investor, when I talked to Jason and early on, maybe I didn't realize this as much, he'd be like, dude, I'm not lending you that much. And I'm like, yeah, you're crazy, dude. This deal's a good deal. And then I go talk to another lender, like, we're not lending you that much. I'm like, okay, well, this deal must be shit, right? And I don't think you guys realize that service that you're providing to real estate investors, whereas, hey, man, those institutional guys, they don't care. They're just looking at numbers and checking boxes and praying to God that it's all
clean. They don't know anything.
No.
How would they?
No clue. And you could pull up and be like, well, I just did a loan for a borrower, and it took him forever to sell. I remember talking about this one on the city-county line, and you're like, yeah, I had a borrower who I lent money to over there, and it took forever to sell. I don't think you should do the deal. And I think ultimately you wound up being right because we had to convert it to a rental because we couldn't get it sold. And that's that intimate knowledge of the market that you have that we take for granted because we think we're equally as smart, but you guys push paper all day, take that politely, and you see all these loan requests and transactions and staring at MLS and submarkets all the time, and you know how your loan performance at any given time.
Yeah, it's a good point, and we've had this conversation before. Like who's ever listening, whoever private lenders or hard money lenders are listening, you know, if you've been doing deals, like you're looking at a lot more deals than the average real estate investor is. Yeah, they might have a little bit more hands-on experience with some of the construction component or some other stuff, but like I'm looking at dozens and dozens of deals a day, you know, on MLS, you know, hundreds a week. Like that's a ton. Like that is a ton. And like you take it for granted that like you really are the expert. And every real estate investor who comes to you, you know, thinks they know they're emotionally attached to how much profit they're going to make per deal. So they think they know it all perfectly, and that's okay. And there's a good way to communicate and in essence, reverse sell them on why you're right and why they're wrong without telling them that. And I'm never going to insult somebody on that. I'm going to say, hey, listen, this is where I think we're going to be at. Like, I'm a little concerned of this and this. No, I got it all taken care of. It's all good. And I think to make yourself a good hard money lender that borrowers respect, you kind of have to stand up and explain your thoughts to them so they get it. You know, I'm sure there's lots of deals. I mean, we'll think about it like this. Like Ian's never really, you know, not performed on a deal before. So every other deal that he went with another lender, I could have done and made money on, right? So like,
yep.
and that's okay. I mean, Chris and I were talking about this borrower that between like 2007 when we started and like 2013, maybe I did 100 loans. We did 100 loans for him. They were higher leverage, a huge home buyer in Northern Virginia. And he came back to us, and you know he'd come back to us and be like, "Hey, if you can give me 100% financing in these terms, I'll do deals with you." And I was like, "It doesn't work," and it like didn't work. And his rebut to me, and you might have heard me say this story before, is like, "Would you rather work with a newer investor that doesn't really know what they're doing and that you can charge a higher rate to, and they can bring more money down and you have less exposure, or to me, who is proven. And he makes a very valid point, and I never disagreed with him. I never formally disagreed with him on it, but I wasn't comfortable doing it, right? Like I just wasn't comfortable doing it because that day could come where the dominoes just collapse, and then I'm screwed because my collateral was at, I was doing high leverage, 100%, or he'd wanted 100% financing. So, and I think about this, and Chris and I have this conversation. It's like, with this particular borrower, like he hasn't, I see who he's lending, it's public record, right? So I see that he's getting loans and he's repaying stuff. Like I probably left $1 million on the table, but I could sleep at night, right? So like as a lender, you got to stay inside your comfort zone, and you respect your side, the borrower respects, and the client respects their side, and it's kind of good to have a candid conversation.
Well, in the market knowledge, I shot you a message. Is we know a lender, and he reached out, and the guy's not normally a Baltimore lender. He lent to somebody in Baltimore.
Good point.
And he got jammed up, and then he's calling me. He's like, "Yo, what do you think the value is?" And I'm like, you think it's worth 300? It's not. I understand there's comps there, but you're on a main road. It's not the best area. Yeah, you go 3 blocks away. Like Baltimore's very, very specific. And I'm like, dude, you just need to cut your losses and get out. So like, and I think that's why people have this allure to be like, well, I mean, just from the outside looking in, well, I could lend more money out and I'll start. And this happened to us in the commercial real estate side is like, we can go buy deals in Louisiana and the deal, it's so much better. But you know what? Our learning lesson, and we've talked about this on our podcast, is like, I don't know the path of progress. I don't know the intimate knowledge. Yeah, from a macro level, I understand the Baton Rouge and the Hattiesburg and all these other markets. On a micro level, from a block by block basis, I don't. And that's why we're divesting some of our commercial assets that are out of state and bringing them back to where we are the experts. We know the best path of progress. We know all the vendors that can come and service the site. We know the product type because it's in our backyard. It's within a 4-hour radius of us. And that was a big learning lesson for us. I think it's probably something similar to what you were just saying. And we were saying about being market experts and being the best lenders. And I really do rely on our lenders, not only from, if I'm using a hard money lender or an institutional back lender, because again, you guys look at way more deals than we do. And performance success way better than we do. Because I'm just looking for a deal that fits my metric. You guys have a metric and you're looking for deals to come into your box. So your inbound lead flow and success, you get to see the project all the way through. I don't get to see everybody else's project that they're trying to launch or sell because I don't keep track of that data. It's not that important to me. I only care about the deals that we're doing.
And we're not always right. Like there's deals that just, you got to sleep. It's important to be able to sleep well at night and, protect your capital investors. And, it also depends on what type of capital you have. And I talked to hard money lenders about this that are controlling other folks' capital. And I'm like, listen, you want to get risky with your own capital or risky with capital that might be very passive that, in the long run, it's going to work out. That's okay. But if you're bringing on a newer investor or, a capital source that doesn't have a big risk tolerance, like you got to just be more conservative. Because your hard money lending business will never grow if you don't take care of your capital investors and make sure they're getting paid. Like they've got to, or they're not going to want to reinvest with you over and over. Correct. I mean, we had a deal where we made an absolute fortune early on. That was a very bad default, and the deal was a default for a long period of time. We got countersued. This was back in the day. I mean, the reason that we don't have our investors on our notes anymore and that we do straight assignments was because of this. Because when we were named in a lawsuit because the deal, we went to foreclosure, and in order for them to stop the foreclosure, they filed bankruptcy, then they countersued us. So and during that, we had to get dragged into court to protect ourselves along with the capital investor because he was named on it, on the note. Big no, don't do that. We ended up, and the court, threw it out, and we were able to foreclose on the property finally. And in essence, our payoff went from like 400 to 500. The capital investor made a fortune, but he was scarred because he wanted to be a passive investor. He didn't want to, go through all these headaches. We were comfortable with it, but he wasn't. So like, you got to put the right capital involved. And I think that's important. And I think Ian knows that as well. Like when he's doing deals, if he's got a deal that's like down, and even today, as he's doing larger commercial deals, he's good about matching the capital for the project. It's just going to be a quick, easy and out deal. It's just going to be a more sophisticated deal that not only do I want capital, but I also want somebody's opinion that could help me navigate. Like those are all things. And another thing that I've talked to hard money lenders, and if you're new at this, you're probably not used to this, but if you've been around this for a long period of time, you've probably witnessed this, that some of your clients will outgrow you. They just will. They get too big, they do too many deals, and they get private lenders themselves. Like they raise the capital themselves, or they have their own cash and they do it. And in essence, or like Ian, they grow into other asset classes. Ian took his hundreds of rental properties and say, hey, I've outgrown these rental properties. I'm going to start buying commercial properties. And we were able to, luckily kind of be involved with that by being limited partners on some of his buildings. And in essence, we weren't a hard money lender on it, but we were a limited partner. We were able to invest capital on those deals. But like, that's the nature of the progression.
Yeah, that's true. But then what was interesting is, like, as we started to leverage our skill sets and, I started to leverage my network, I would stumble on people saying, hey, I'm doing a commercial real estate deal, but I don't know how to fund the capital stack. And then that turned into me saying, well, I know Jason, and if we can set up a hard money loan and maybe get some equity with this, let's do it. And we just did a deal. Did it outperform your hard money loans? Maybe not. You could probably comment better. Yeah, you could comment better on that. But in the end, we were able to take. Then I'm sitting here going, okay, well, I got Jason and Chris. I know they're looking for some other venture, more, let's call it venture type deals or equity type deals, so they can get some depreciation and stuff. I can't fulfill every single thing based on some of their terms they want, but I got this other guy and he needs capital. And it's the same as early on when I was like, well, I'll take whatever capital I can get to do it. And I'm not always going to trip over the penny. And I had a guy that was like, yo, I don't want to take any debt. I just want a capital investor, but we were still able to structure it as a debt plus equity. And that's how we build a relationship. And I think that's what's interesting is, again, you not only are you guys market experts, you also get to see everybody's books. And I think there's other opportunities that lie inside that as well.
Yeah. And actually, that's a good point, because we could talk about a deal that we've done multiple times where, on a traditional commercial deal, now we're talking about, higher end projects, which is still relevant. But, in a commercial project, let's say it was $1 million, right? And, you went to your bank and then you raised capital. Maybe did some sort of syndication or limited partnership agreement or whatever. So let's say you went to your bank and got a 70% loan, and then you raised, $300,000 and you got equity from some of your, private sources, right? And you put that deal together. There's been deals in the past that we've been involved in when you're like, hey, will you help me, or can we collectively raise capital together to try to do a deal like this? And we look at it and we're like, hey, you know what? Why don't we do this? This isn't an asset class that we typically do. Might not even be an area that we typically do, but why don't we structure a deal where we can structure it as like a hard money loan and then equity? So instead of you having to go raise all this money on this deal, why don't we just do a first position hard money loan at a 40-50 LTV deal? Our capital investors would be okay to be involved in there. It's such a low LTV deal. And then, instead of having to go raise $1 million, you can go raise $500,000, and it's a win-win for both sides. So it's just the creativeness that this stuff turns into.
Yeah. And again, that was just saying, like, a lot of that was because, like, we built a good relationship, and it was like, well, how do I keep Jason and Chris involved? And I know that as long as they have first position, we can figure out how to do deals together. And there's been instances where, anywhere from $1 to $3 million we've been looking at. And I'm like, okay, well, I know if I go to Jason and ask him for, we're buying this for $1 million, we need to put a couple $100,000 into it. He'll give me $5, anywhere from $3 to just, whatever, $400,000 to $700,000, depending what it looks like. He'll, structure it as a first position. I'll go backfill it with I'll put our capital up and then backfill it with investor capital. And it's like, dude, again, it comes down to the ease of transaction. When I go and deal with the life insurance companies or the local banks, dude, on commercial assets, yeah, the money's a little easier, but there's a lot of shit that goes into it. And it's like, all right, well, I could just go to Jason and Chris and take the path of least resistance and do this. And we recently did this. Did you guys get an Ambler? I can't remember. But we did a deal. We did a deal in Ambler where
we're the hard money lender on it.
Yeah, you guys are the hard money lender.
400,000.
Yep. And then we have the rest of the capital investors came in, and that's how we're navigating this and pushing the money through. And it's like, okay, well, when we told the capital investors, hey, no pref payments, and here we go. And that became the whole capital stack, so $800,000, $900,000 project. I got 400 from them. I made 3 phone calls, got the other money, and off we went. And I actually, one of the guys in there is a hard money lender in your group. But he had IRA money, and he's like, I just need equity pops on that. I don't really care about lending that. I want the equity pop. I like what you're doing. Let me try it out. So that's what we've been working on and going from there. So.
And I think that's kind of the key takeaway of all this. Like, don't just assume that what your borrowers are thinking, and don't just assume that they want the cheapest rate and the highest leverage. I mean, even when one of our business partners was in the office and we were doing some ongoing training here recently, he was like, yeah, but like if they come to us, or if they go to whoever, RCN, Lending Home, whoever, they're going to need, 35,000 cash to close. And I was like, yeah. And if they come to us, they're going to need $75,000 or $80,000 cash to close. He's like, yeah, that's the challenge. And I'm like, it might not be a challenge. You think it's a challenge because you think it's a big gap, but you're not taking into consideration, and you're not valuing us having private funds and flexibility, and very easy flexibility, because, that's such a big component of all this, but all you're doing is looking in consideration, and you're comparing, cash to close, and comparing, price point. And the price point these days is not much cheaper than a hard money lender. Our 12.99 compared to, 10.99. I mean, I don't think fix and flips are 9.99 anymore, but maybe 10.99, 11.99, 12.99. Like, that's pretty damn much the same. The leverage is the big difference. And that's when you have to have a conversation and see what's up. And listen, some people might only have 40 grand, so we can't do the deal anyways. But also, do you really want to be involved with a borrower who needs, $200,000 loan and only have 40 grand to their name? There's an argument that that's just not enough cash for them to do anything, with cost overruns and things like that. So you gotta understand the facts. And I always sum this up of, guess what? If we tell somebody we're going to close a loan, we're going to close a loan. And if anyone else who's a private lender, hard money lender in here, who controls their own capital, when you're telling someone that you're going to do their deal and assuming it's exactly laid out how we're expecting it to be, like, we're going to close their deal. Like, you never know what happens with institutional backed capital. Of when does their leverage metrics change? When does their rates change? When do they implode? When do they decide, what, I'm going to take my football elsewhere because I don't want to be in this asset class anymore? It's just a matter of time. And again, this is not like downplaying their products or hating on them, because they do serve a good purpose in our space. The point is they're not the only thing in this space. And depending on the situation, our product, and collectively all of our products, might be superior to them in a lot of instances.
And you hit the nail on the head. You absolutely hit it on the head. And what is it? When you tell somebody you're going to close, you're going to close. You're not changing it all the way to the closing table. We had an apartment building before we really figured out how to work together commercially in West Virginia. And we had to go to somebody because the capital stack was a little short, and they changed their metric about 18 times because they had to go back and report to the bank. And they presented themselves as a private lender. They changed their loan terms probably about 5 times until we got to the closing table. I'm like, dude, I can't do this. I just need a number, and that's it. And I want to know that you're going to close, because I told, and this is where our two worlds cross, you told somebody you're going to do the deal. I told this lady that I'm going to buy her apartment building. And usually in my world, I get the best deals because they know we're going to close. It's the path of least resistance. Something else happened to this deal where it fell apart, and they're calling us, yo, can you close in 2 weeks? Can you do this? Can you do that? All right, well, that's a different conversation. And I need that person on the other side to execute exactly how they say they're going to. And I think that's where our two worlds absolutely 100% cross. And I think that's the best way to summarize this.
Cool. Well, so when we originally started, I was like, we like to keep these podcasts about 10 minutes or 12 minutes.
10 minutes,
but my counterpart in the other podcast that we do, like, both of us kind of like to talk. It's not, me and Chris, where Chris can keep me on point and kind of sum things up. Like, we both are blah, 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 blah. So hope everybody enjoyed this episode. Why don't you just give, a little plug about, what you're up to and how people can find you online if they want to reach out.
Yeah, if you want to check us out, we're at Equity Warehouse across all the social platforms. And other than that, you can go check out equitywarehouse.com. You can see how we co-invest and co-lend with our friends and family. Always happy to have a conversation. And furthermore, for people on your podcast, just, reach out to me via Instagram. I will connect and talk. But if you have a question, if you're doing a commercial loan, want some advice, we're here. Always happy to have a conversation. And, I appreciate you having me on.
And you got Buffed Energy. Don't forget that.
Oh, yeah. BuffedEnergy.com, officialBuffedEnergy.com. On this very serious note, we didn't really talk about my story. I was a fireman for the city of Baltimore, me and my business partner, Dan. And we do have a big social media following for firefighters. And we created this product, not only because we like energy drinks, but because it supports first responders. Proceeds of every can goes into a nonprofit that we control. And we look to help first responders who are hurt, either off duty and can't return to work, or volunteer first responders who get hurt performing the volunteer work as like a volunteer fireman and can't return to their job. That's something that's near and dear to our hearts. So we're looking forward to growing this. It started out as a little pet project, and like everything in our lives, it's turning into a business, and it consumes Jason and I's conversation because I'm bouncing all these ideas off them every morning. So either way, it's been fun, and it is something near and dear to our hearts. So I'm looking forward to growing that. And it turns out you can lend private money in the drink space, because I just made a private note to our company to fund it, and I'll be interested to see how that goes long term. So
that is true. Do you still drink black coffee? Do you still drink coffee in the morning?
Not every day.
Well, now that you're drinking, I'm guessing probably 2 of those a day.
Dude, this is bro. No, these are only 1 a day.
So there's 200 milligrams in that, right?
There's 200 milligrams. The thing about coffee, and this is a shameless plug for ourselves, is this has caffeine and anhydrous in it. So it's a predetermined amount. When you brew coffee, it comes down to how much rain the coffee beans got, how much they've been roasted. You can get anywhere from 10 to 200 milligrams of caffeine. But when you pour a cup of coffee, you don't always know how much caffeine you're getting in that cup of coffee, depending how it was brewed. So that's our combatant against coffee. But I do enjoy the warmth of coffee, especially when it's 18 degrees out in the morning.
No doubt.
But I mean, you got to remember, when we were firemen, and I know I'm going a little off topic here, is in the morning you go into work, you drink a cup of coffee, and then at 3:00, because we work 24-hour shifts, and that used to be shift change, we'd drop another pot of coffee and rip coffee because we'd be up all night. So for me to consume 400 to 600 milligrams of caffeine and go right to bed, it's completely possible. The only time I had an issue was when we produced the first batch. I literally had to take 3 sips of every flavor. So I wound up drinking 20 small cups, and dude, my head was roasting. So that was it. That was an interesting torture to the body.
Well, there's definitely some caffeine drinkers in our group, because I know several of them, and I've seen them post content on it. So definitely check it out. I appreciate it, Ian. Thanks so much.
See you guys.
We hope you enjoyed this episode of the Private Lenders Podcast. Please note that the opinions stated by all the speakers on this show are only opinions and not intended for legal, financial, or accounting advice. Please make sure to always check with your own legal, accounting, and financial professionals. If you enjoyed this episode of the Private Lenders Podcast, we'd appreciate it if you would spread the word. Make sure to check out hardmoneymastermind.com, the #1 free community for new and experienced private and hard money lenders.